Hello, it's Mo. Welcome back to the property vlog. A couple of weeks ago, I attended an amazing presentation by Handelsbanken. It was by James Sproule, who is the chief economist for Handelsbanken UK. And I thought I would share some of the key insights from that presentation with you on the property vlog channel. The presentation was about 90 minutes in total, but I wanted to pull out some of the key information and share it on here, specifically what is relevant to the UK property market. So a few disclaimers before we get started. Obviously, this is not financial advice. Obviously, these aren't my slides. And in addition, this was a presentation from the 4th of May. So there may be some information, well, there will be some information which is out of date because there's been sort of various developments since then. So hope you get some value out of it, and let's jump in. So if we go to the first slide, so this is the economic surprise index. Essentially, the thing to focus on here is the green section since 2016 on this top chart. So this is basically how good are analysts at forecasting and predicting how good the UK economy will perform in the future. So the top chart in green shows all the times when the actual UK performance, the actual economy of the UK has been better than analysts and forecasters have predicted. So as you can see, since 2016, consistently forecasters have underestimated the UK's economic performance, which I thought was just like an interesting thing to start with. So so since 2016, basically been underestimating the performance of the UK economy. Let's go to the next slide. So the next one is UK GDP. So as you can see, the sharp drop here is COVID in 2020. We've been steadily climbing back since then. Today, we are pretty much at 2019 levels, but the growth trend, which is this dark blue dotted line, you can see it's not as good as sort of the angle of the light blue dotted line that we were on before, which means obviously we've dropped down a level, but even now the growth isn't as good or isn't forecast to be as good as it was. There's a few reasons for this. Number one, consumer spending being hit by energy prices and falling real pay, constrained government spending, lethargic business investment, and a continuing trade deficit. So there's some of the reasons why GDP growth is not expected to be as good as before, but we are back to pre-pandemic levels now. UK confidence. So there's a lot of information on this slide. Essentially, the summary of this slide is people and businesses are generally happy and their happiness is improving, but their happiness is not as good as it was pre-pandemic, which sort of probably makes sense given everything that's going on. But generally, when you speak to business and you speak to people, they're pretty happy, not as happy as they were, still a bit concerned for the future. And there's various sort of ways that can be measured through PMI, consumer surveys, and degrees of happiness, which is just various metrics to sort of measure confidence and happiness. So UK savings and consumer credit, we won't spend too long on this slide. Essentially, through COVID, we collectively saved a bunch of cash because for a broad section of society, we were forced to stay in our homes. We still got paid, or at least we got a percentage of our full pay, if not all. And therefore, on the graph on the left, you can see we saved about 190 billion pounds of extra, so over and above what we were projected to save anyway. We've saved an extra 190 billion. And on the right hand side graph, we paid off our credit cards, we paid off our loans, which was obviously sensible given that the rates on those products are much more than savings rates. So no real surprises there. The only other thing to mention is that this graph on the left is starting to sort of turn a bit more level. So it's been growing and now it's sort of flattening off. And that's basically consumers beginning to draw, as it says there, consumers beginning to draw on longer term savings to fund consumption. So as everything's getting more expensive, people are starting to dip into some of the savings that they've got. Okay, UK employment and earnings. So left-hand graph is UK real and nominal pay. So nominal average pay awards are about 6.5%, but obviously when adjusted for inflation, the real pay is actually negative. So that's sort of the reason for the various strikes that we've seen. Going forward, as inflation cools, the gap between nominal and real will obviously become less, and that will those lines will get closer together, and that would then obviously affect the expectation on pay awards going forward on those. In terms of UK unemployment, which is the graph on the right, starting to rise. You can see down here this red line is just starting to rise above 3.75%, but it is coming off a 40-year low, so it's still very, very low. So it's not too concerning. So inflation is what everyone talks about. So the left-hand chart is the Bank of England expectation, currently just over 10% on inflation, projected to fall sharply as we compare current prices with already inflated prices and already sort of we're comparing post-Russia invasion of Ukraine prices with, we're getting to sort of, well, it's now been a year since that. So the price is already high and now they're high. So it's sort of comparing high with high. So you don't have that sort of base effect. Making everything seem a lot worse in terms of price changes. The Bank of England expects us to be below the 2% target by early 2024, which is sort of here. James, who's the chief economist from Handelsbanken, thought that would probably be unlikely to happen so quickly. It will happen, but it won't happen so quickly, partly due to more sticky and persistent wage inflation. And his view was that it will fall quickly to around 4%, but will be harder to get down from there. On the right-hand side, the OBR inflation forecast shows the inflation in various goods and services, most notably food and drink in purple, gas and electricity bills in red. As you can see, as these bars start to get smaller, the inflation comes down. So on to UK monetary policy. So as you can see on the left, rates have been rising. So that's the red line here. Rates have been rising. I think at the time of this, it was 4.25%, now 4.5%. James thinks it will remain between 4 and 4.5% for the medium term. Why is that? Well, partially because inflation is going to be stickier than people are anticipating. So it will come down, but he thinks it will be a bit stickier and won't come down as quickly as forecasts are showing. And also very, very steep interest rate rises as we've had. This is almost a straight line up. Usually take about 2 years to see the full effect of rate rises. So how you behave, how your clients behave, how they then behave, and then you behave in response to that, all of that stuff sort of takes a while to feed through. So that's the reason that he thinks it will be a bit stickier. And projections for rate rises, rates to be 3.5% by the end of 2025. So it doesn't think it will go any higher than 4.5%, and then it will start to sort of step down to 3.5% by the end of 2025. Okay, on to UK budget government finances. So we've obviously got a deficit. Net debt is still increasing. So we've got net debt is this one. So that's net debt as a share of GDP. So effectively, net debt still increasing. The Chancellor wants to bring it down as a percentage of GDP in the next couple of years. James thinks it's fairly alarming, given that if we look at tax to GDP, it's at a level that's not seen. We haven't seen such high tax receipts since Clement Attlee was PM in 1945 to 51. I think that's on this one. So this is tax to GDP. So you can see that's now at the highest rate. So sort of the tax receipts are very, very high, but we're still borrowing money. So this is from James, the three big problems that the UK faces. Number one, very, very high tax burden and an evidence that people are avoiding work because they don't want to pay the tax. Number two, growing expectations of what the government and state can provide. So a much bigger state, a much bigger government on what they can and should provide. And number three, a commitment to not borrow anymore. So a commitment from the government to not borrow anymore. So obviously you can't meet those three things. They are incompatible. Something has to give. James suspects it will be the borrowing that will give. So a commitment to not borrow anymore will go out the window because that is what's happened historically. Okay, UK budget consumers' income we're going to skip past. Obviously, you can see it ticking up. Let's just flick onto this one. So UK house prices. So this oscillating sort of blue line is house price growth, which for the most part since 2005 has been positive, bar obviously 2008, 2009. The green line, so this green line here, is the average house price, which you can see is set to dip slightly before recovering. The expectations that the total peak to trough drop will be shallower than the global financial crisis, which is here, and it will be around about 7.8%. So that's this drop here. Will be to about 7.8% peak to trough. Some of that we've obviously already seen. In terms of UK housing affordability, which is over here, as interest rate rise, with rising interest rates, obviously mortgage payments as a percentage of income have risen. So that's this green line here. Obviously that becomes more of your income, and house price to income ratios topped out at 50%. So that's the highest level it's been, since this graph started. So at 50%. So that's now dropping. Interestingly, one of the stats that James presented, 2/3 of people in the UK own their own homes, and about half of those homes have a mortgage. Excuse me, so that's obviously quite a lot of mortgages. Okay, UK rental prices. So on the left, we can see, particularly here, rents are soaring, and any private sort of landlords will have seen that in their local area. Although these increases are less than inflation, so they are soaring. It's obviously in the headlines a lot, but it is less than inflation. There's a shortage of rental properties, and that will only fuel this even further. This is being supported inadvertently by the government, who, as private landlords will know, are putting more and more rules on private landlords. There's less and less favourable tax treatment for landlords, which means there are a lot of landlords leaving the market. Plus, on top of that, we've got a sort of out-of-date, very efficient planning system that's not facilitating new build to rent stock quickly enough. So it's not getting that stuff through, which means just the supply and demand is totally out of balance, which is why these prices are flying up. On the right-hand graph, so this is UK gilts versus property yields. So gilts are the dark blue, and house price to rent ratio, which the yield is the green. So usually you would expect more of a return from property given the risks and costs associated with owning and letting property, so voids, tenant issues, etc. So normally you would expect the green line to be above the blue, and as you can see, most of the time it is, because UK gilts are considered like very low risk. So that is obviously not happening at the moment. So we would expect this to correct, and that's the way it would correct, would be either or both through increase in rents, which we've seen over here is going to happen. We've got rents increasing, so that means the yields will get better, and also capital value adjustment, so prices coming down. As we've seen from the previous slide, there's an expectation that prices will come down slightly, and those things will correct the situation we've got here. So overall, James's sort of sentiment, things are looking better than they were. His sentiment was that people were maybe overly cautious at the moment and lacking in confidence, despite the sort of data. But with the events in the US, specifically the regional banking failures, it's not that surprising that people are lacking a bit of confidence. The expectations that inflation and rates will come down, probably they won't come down as quickly as people are expecting. They will come down, but not as quickly. So yeah, it was a really, really good presentation. To follow on from this, James has a weekly podcast called Handelsbanken Insights, which is fantastic. So definitely encourage you to go and check it out wherever you get your podcast from. So thanks for watching. Hope you enjoyed a sort of slightly different format for the property vlog video and got some value out of it. I just thought some of these charts were really interesting, and to have them all in one place was very interesting. So check out the description below. I'll put the link to the podcast, the Handelsbanken Insights podcast, in the link, as well as links for KHP and stuff like that. So thanks for watching, and see you next week.